While you are sleeping, a silent thief is systematically draining the value of every dollar you've worked so hard to save. Most people believe that keeping money in a bank is the safest way to build a future, but in reality, you might be participating in a slow-motion financial suicide. Today, we are exposing the silent wealth killer and the 3 fundamental mistakes that keep the masses trapped in a cycle of diminishing returns. Body. To understand why most people never truly become wealthy, we have to look at the concept of the money mirage. Imagine you have a bucket of water. You believe that as long as you don't pour the water out, the bucket will stay full. But what if there is a hole in the bottom that you cannot see? No matter how much water you add, the level never rises. It might even be dropping. This is exactly what is happening to your bank account right now. This isn't just about spending or bad luck. It's about a structural flaw in how we are taught to think about currency versus capital. The first mistake, and perhaps the most dangerous one, is the psychology of nominal gains. Most investors celebrate when they see their balance go up by a few percentage points. They feel a sense of security seeing the numbers grow. However, they are looking at the nominal value, the face value of the currency, while completely ignoring the real purchasing power. If your account grows by 5% but the cost of the things you actually need, housing, healthcare, and high-quality assets, rises by 10%, you haven't gained wealth. You have actually lost 5% of your life's energy. You are running on a financial treadmill that is moving faster than your legs can carry you. Wealthy individuals don't look at how much money they have. They look at what that money can command in the marketplace. They understand that saving is often just a polite word for losing slowly. The 99% are trapped because they have been conditioned to value the safety of the dollar over the growth of the asset. They see volatility as a risk, but they don't realize that the ultimate risk is the guaranteed loss of value through currency debasement. If you are sitting on a pile of cash, thinking you are playing it safe, you are actually standing in the middle of a burning building because the walls are closing in on your buying power every single day. We need to shift the perspective from accumulating units of currency to accumulating units of production and time. The second mistake that keeps 99% of investors from ever reaching true financial freedom is what I call the diversification delusion. You have probably heard the age-old advice, don't put all your eggs in one basket. On the surface, this sounds like wisdom. It sounds safe. It sounds professional. But for the average investor, this advice is often a one-way ticket to mediocrity. When you diversify too early and too broadly without a deep understanding of your assets, you aren't protecting yourself against loss. You are guaranteeing a lack of significant gain. You are spreading your capital so thin that even if one of your investments performs exceptionally well, the impact on your total net worth is negligible. The wealthy operate on a completely different frequency. They understand that while diversification preserves wealth, concentration builds it. Most investors buy 10 different mutual funds or a handful of popular stocks because they saw a headline or a trending video. This is not a strategy, it is a hope-based lottery. By trying to follow the crowd, you end up with diversification. You own a little bit of everything, which means you effectively own a lot of nothing. You are paying fees on multiple fronts, following dozens of different charts, and yet your portfolio moves at the speed of a snail. This mistake happens because people prioritize the comfort of the herd over the conviction of the individual. They are more afraid of being wrong alone than they are of being wrong with everyone else. Real wealth is built by finding a high-conviction opportunity, whether that is a specific business, a unique real estate play, or a breakthrough technology, and leaning in with focused intensity. The 99% are taught to be generalists with their money, but the 1% are specialists. They wait for the right pitch, and when it comes, they swing with everything they have. If you are constantly jumping from one safe asset to another, trying to hedge every possible risk, you are essentially vibrating in place. You aren't moving forward, you are just staying busy. To break out of the middle-class trap, you must stop treating your portfolio like a buffet and start treating it like a specialized toolkit. You must learn to identify the difference between real risk and perceived volatility. Most people run away when prices fluctuate, but for the educated investor, volatility is simply the price of admission for outsized returns. The third and perhaps most silent mistake that 99% of investors fall victim to is the optimization paradox. This is the internal drive to constantly do something with your money. In a world that rewards activity, we are conditioned to believe that more action equals more results. If the market is up, we feel the urge to buy more to avoid missing out. If the market is down, our survival instincts scream at us to sell and protect what is left. This constant state of emotional reactivity is the ultimate wealth killer because it forces you to trade your long-term freedom for short-term emotional comfort. You are essentially letting your lizard brain manage your retirement fund, and that part of your brain only cares about immediate safety, not future prosperity. When you react to the headlines, the social media hype, or the panic in the streets, you are effectively paying an emotional tax on your capital. Every time you enter and exit a position based on fear or greed, you lose a piece of your momentum. You lose money to spreads, commissions, and taxes, but more importantly, you lose the power of compounding. Compounding is the eighth wonder of the world, but it is a jealous mistress. It requires uninterrupted time. Most investors never see the hockey stick curve of growth because they keep resetting the clock every time they get nervous. They treat the market like a slot machine rather than a garden. They dig up the seeds every 2 days to see if they are growing, and then wonder why they never have a harvest. This mistake is silent because it feels like you are being responsible. You tell yourself you are managing your risk or staying informed, but in reality, you are just being busy to mask your anxiety. The 1% understand that the most profitable action in investing is often doing absolutely nothing. They have the discipline to sit on their hands while the rest of the world is losing their minds. They don't look at their portfolio daily because they know that wealth is not built in days. It is built in decades. If you cannot control your emotions, you cannot control your money. The 99% are constantly looking for the next hot tip or the perfect exit, failing to realize that the perfect exit was never the goal. The goal was to own assets so valuable that you never want to sell them in the first place. By seeking constant optimization, you ensure your own exhaustion and guarantee that you will fall short of your true financial potential. The 99% are obsessed with accumulation. They spend their lives trying to pile up as much cash as possible, thinking that a big number in a digital account equals safety. But the 1% look at money through a completely different lens. They see it as a current. The word currency itself comes from the word current, meaning it is designed to flow. If water stops flowing, it becomes stagnant and toxic. If your money stops moving, it begins to lose its vitality. To escape the silent wealth killer, you must shift your mindset from being a collector of money to being a conductor of capital. You need to understand how to keep your dollars moving through different assets at a speed that outpaces the systemic erosion we discussed in part 1. Wealthy individuals think in terms of doubling cycles. They don't just ask, what is the interest rate? They ask, how fast can I get my initial investment back so I can move it into the next opportunity? This is the secret of the rule of 72 in action. If you can shorten the time it takes for your capital to complete a cycle, you aren't just growing your wealth. You are accelerating it. While the average person is happy with a 7% return over 30 years, the sophisticated investor is looking for ways to use leverage, tax strategies, and high-conviction plays to move that capital through multiple cycles in the same time frame. They aren't working harder. Their money is working faster. This shift is what separates those who work for money from those who have money working for them. When your money is stagnant in a traditional savings account, its velocity is zero. It is sitting still while the world around it gets more expensive. By the time you decide to use it, its speed has been surpassed by the rising costs of assets you wanted to buy. This is why the middle class feels like they are falling behind even when they receive a raise at work. Their income is increasing linearly, but the cost of the good life is increasing exponentially. To win, you must stop parked capital. You must learn to identify dead money, funds that are sitting idle and not contributing to your future freedom. Every dollar you own should have a job description, and that job should be to find another dollar and bring it home as quickly as possible. The fourth layer of this silent wealth killer is the confusion between what constitutes an asset and what is merely a glorified liability. Most people in the 99% spend their entire lives working to buy things they think are assets, but which actually drain their cash flow every single month. The most common example is the primary residence or the luxury vehicle. We are told that these are investments, but if you look at the math, They are often the biggest anchors holding you back from true velocity. An asset puts money in your pocket. A liability takes it out. If your wealth requires you to keep working a job just to maintain the maintenance, taxes, and interest on it, then you aren't owning your lifestyle. Your lifestyle is owning you. The trap is set by social comparison. We see people with the big house and the German-engineered car, and we assume they are winning the game. In reality, many of them are 1 or 2 missed paychecks away from a total collapse. They have built a wealth mirage, a beautiful exterior that is hollow on the inside. This mistake is deadly because it is culturally celebrated. People will congratulate you for taking on a massive mortgage or a high-interest car loan, calling it a sign of success. But every dollar that goes toward a depreciating liability or a non-productive asset is a dollar that has been removed from your velocity machine. You are trading the compounding power of your future for the temporary status of the present. To break this cycle, you must develop a radical level of financial honesty. You have to look at everything you own and ask, is this working for me, or am I working for it? The 1% focus on acquiring production assets first, things like businesses, cash-flowing real estate, or intellectual property, and they use the income from those assets to pay for their luxuries. The 99% do it backward. They buy the luxuries with their own labor, leaving nothing left to invest. This fundamental flip in strategy is what creates the massive gap in net worth over 10 to 20 years. While others are paying off the interest on their lifestyle, the wealthy are collecting interest on their production. By the time you realize that your success symbols are actually wealth anchors, it is often too late to regain the lost time. The most expensive thing you will ever pay for in your life is not a house, a car, or even your college tuition. The most expensive thing you pay for is the information you don't have. This is what I call the knowledge tax, and it is the primary reason the 99% stay trapped in the middle-class cycle regardless of how hard they work. In the financial world, there are rules that are hidden in plain sight, tax codes, legal structures, and investment vehicles that are designed to benefit those who know how to navigate them. If you don't know these rules, you are essentially playing a game of chess while your opponent is playing a completely different game with a different set of pieces. You are losing because you are operating on an outdated map of the world. Think about how much you pay in taxes, hidden fees, and lost opportunities simply because you weren't aware of a better way to structure your finances. Most people take the path of least resistance. They use a standard bank account, they follow the standard retirement plan provided by their employer, and they file their taxes using the most basic forms. While this feels safe and normal, it is actually the most inefficient way to handle capital. The 1% invest heavily in their own financial education because they know that one single piece of information, a specific tax strategy, or a way to protect their assets from litigation, can be worth millions of dollars over a lifetime. They don't see education as an expense. They see it as the ultimate leverage. The tragedy of the 99% is that they stop learning about money the moment they start making it. They focus entirely on how to earn and completely ignore how to keep and how to multiply. They rely on experts who are often just salespeople in suits, pushed to sell products that benefit the institution rather than the individual. To escape the silent wealth killer, you must take full sovereignty over your financial mind. You have to stop outsourcing your thinking to people who don't have your best interests at heart. In the digital age, ignorance is a choice, and it is a choice that comes with a devastatingly high price tag. If you aren't spending at least as much time studying the flow of capital as you do working for it, you are guaranteed to remain a servant to the system rather than its master. The journey from being an observer of wealth to a creator of it requires a complete system reset. You now know that the silent killers, inflation, false diversification, emotional reactivity, and stagnant capital, are the invisible walls of a financial prison. To break through, you must adopt the blueprint of the sovereign investor. This isn't about getting lucky or finding a moonshot investment. It's about becoming a person who manages capital with clinical precision. The first step is to reclaim your time by prioritizing velocity over accumulation. Stop asking how much you can save, and start asking how quickly you can move your money into assets that produce cash flow without your physical presence. True financial freedom is the moment your passive income exceeds your cost of living. But you cannot get there if you are still carrying the weight of lifestyle anchors and dead money. You must have the courage to be the boring one in the short term so you can be the free one in the long term. This means liquidating the liabilities that don't serve your future and concentrating your resources into a specialized circle of competence. Don't try to be a jack of all trades. Be the master of one high-growth arena. Whether it's real estate, a scalable business, or a specific sector of the markets, your deep knowledge will be your greatest hedge against risk. The 1% aren't smarter than you, but they are more disciplined in their focus and more aggressive in their pursuit of financial education. The final question you have to ask yourself today is simple. Are you going to continue being a victim of this silent wealth killer? Or are you ready to become the architect of your own destiny? Most people will watch this video, feel a temporary spark of motivation, and then go right back to their old habits. They will continue to let their purchasing power erode while they wait for a better time to act. But the better time is a myth. The only time that matters is now. You have the map, you have the tools, and now, you have the responsibility. Don't let your life's energy be drained by a system designed to keep you stationary. Take the first step, break the cycle of the 99%, and start building a legacy that the silent thief can never touch. Your future self is waiting for you to make the right move.